Good morning. It is 7 a.m. on Monday, June 5th, New York time. Sorry, just checking my clocks up there. Welcome back into week number 2 of trading our live funded account. 10K account with Bespoke Funding Program currently. We are on a mission to take this thing from $10,000 in funding all the way to $2 million in funding by the end of 2023, this year. We just started the 6th month of the year. So we've got about 6.5 months to go. And yeah, I think we can do this. So super excited about how well it's gone so far. And hope all of you guys that are watching this are learning and figuring out exactly what's keeping you from achieving and doing the same thing. So we have a first payout coming up this week. It's a big week here on the funding challenge because this will be our first payout. And currently we are $6.25 above the opening balance of $10,000. And so we're going to be hoping to find at least one good A plus setup this week. And we'll be on the hunt. And any A plus setup that we find, we are going to take it. And so that's what we're doing. We're hunting. We're on the hunt, man. The goal is to take whatever profits that we can make on this next payout, which is on, I think next Sunday, June 11th is when my payout is due. We'll take whatever profits we can and whatever account size, the largest account size that we can purchase for a new challenge, we will do that. And then we will continue to use this 10K account as our master account to copy trade into those other challenges. And so that's the plan. Hope you guys had a good weekend. Not much happened here. It was pretty quiet. Good weather. Got some workouts in, did some house chores, hung out by the pool, had a couple nice dinners with some friends out. It was good. It was good. In fact, I didn't look at these charts since I closed the charts on Friday. When I sat down here about an hour ago was the first time I opened the charts and am just now looking at them really for the first time. I've been scheduling my Twitter stuff for the rest of the day. And so I haven't even looked at any of this. I'm looking at it with you for the first time. Hey, Steven, welcome in, man. Time to climb up into our tree stand. We have one bullet in our gun today. One bullet. One shot, one kill. That's what we're looking for. That's what we're waiting on. And hopefully we can take down a buck today. We'll see. We will see. All right. Let's get into a little bit of analysis. We've got first thing I see is we've got some red folder news coming in at 2 o'clock this morning. Some PMI for, I guess that's industrial services of some kind. I'm not really sure. Not really sure what impact, excuse me, got the yawn. Not sure what impact that's going to have on any volatility. It's actually a pretty light week overall on red folder news. I think the next one is Wednesday morning. We've got some balance of trade coming up. I need to look at my FX, but today, not much. Next couple of days, it's actually pretty light. So we're going to see, does the market want to move now that the President Biden has signed into law the debt ceiling deal that passed the House and Senate over the weekend. So we'll today will be the first day that we really kind of get a feel on what kind of impact that's going to have. The Fed's obviously going to have to sell a bunch of debt so that the U.S. can keep the lights on. So what impact is that going to have? Despite not being red folder news, it is a red folder circumstance, I guess. So I'm kind of interested to see as the markets open up how they're going to respond. Are they going to view a debt ceiling deal positively, negatively? My goodness. Whew. We'll have to wait and see. So, good morning, guys. Welcome in. Hope your weekends went well. We're going to start on the dollar. That's where I'm going to start today, and we're going to go up to the monthly time frame. I'm going to take off this fib stuff here. So on the monthly time frame right now, we just finished out May last week. This is the first full week of June we're coming into. So you can see we opened, we dropped. I want to say we dropped. Yeah, we dropped pretty far down here already. We didn't get all the way back down to this candle. This is the April high right here. And so if you're looking at what price is going to want to do, it doesn't like to leave fair value gaps behind. Currently, if price were to close where it is or go higher, it would leave behind a small little fair value gap of price inefficiency on the monthly time frame. We were on this big tear up. We had a bearish order or a bullish order block right here. We tapped into it. We actually reached into the monthly fair value gap below it. We respected this bullish order block. We did not close down below it. We reached into liquidity, and now since we've traded higher. And so now we're going to want to see, is this the draw on liquidity on the monthly time frame? Maybe it is. You've got relative equal highs up here on the monthly time frame. And I'm just going to do some notation here. So there's your draw on liquidity on your monthly time frame. Of course, you have last month's high, the month of May, right here. That could be the only place it really wants to gravitate towards, and then it reverses down to maybe fill in the rest of this and retest April's high here. I'm going to pull these back out. These were and have been important levels on lower time frames. I'm just going to leave those there. So is this relative equal high up here? Is this where we're going to head for June and July? We will find out over the next couple of weeks. You obviously have relative equal highs down low. You're just inside this dealing range so far. So we're waiting and watching, but you can see a little bit more clear now. You've got your relative equal highs up here on the weekly time frame. Let me pull that down just a little bit. So these relative equal highs up here, you've got last week's high, last week's low. We're still inside of that. It is currently trading higher, and I'm not sure. Yep, so far it has not left a lower wick on this week's candle. No wicks left behind. So we know that even if it doesn't get it early this week, you could anticipate that over the next couple of weeks, that wick getting, if it leaves one this week. It's a lot of days left, so we will wait and see. Your first draw on liquidity is going to be your previous weekly high and your previous weekly low on a weekly time frame. We have had 3 weeks of straight bullish price action. We've had last week a run on both sides of liquidity. It ended up closing bearish, but that's a fairly neutral candle in my opinion. It didn't really do anything. It just ran both sides, and then it closed close to where it opened. Not exactly, but close. Kind of a neutral indecision on what it was doing. So this is just carving out a range, in my opinion, engineering liquidity. So this week that's last week's high and last week's low. That's what we're going to be Those are our first target areas for draws on liquidity for the dollar. We drop down to our daily time frame. So you have Friday's high has already been taken. You see price opened here. This is our first no wick candle. Today it has just opened and just started running up higher. It's taken out Friday's high. You've got Thursday and Wednesday here. Wednesday is the weekly high. You over here traded back up into a bearish order block, and you're in the OTE of this overall time frame. We hit that volume imbalance right here. I'm not sure why that moved. We hit that volume imbalance last week, and we saw massive rejection and resistance off of that. And we're heading back up. I believe, what was I looking at here? Okay, so you had a daily fair value gap right here. That's what it was. Move these in a little bit. All right. So draws on liquidity, previous week's high. You've already taken out the last daily high, and you're reaching back up into where that volume imbalance showed quite a bit of resistance. So if price can get back up there today, we're going to have to watch and see exactly what's going to happen up there. Price came back down. Here we are in an uptrend. So our current trend is up. So we're making bullish order flow. So any down candles or fair value gaps are being respected to the upside. So until we get a closure below this, well, now below this level, this would be a change in structure if it closed below this level. We came down last week into this bullish order block. We filled in these imbalances, and then price rejected off of this bullish order block right here and has since returned higher. So because we're in an uptrend, we would expect this to make a new high. We would want to see displacement through this high if we're going to reach up to these monthly draws on liquidity. Okay. On the daily time frame, you can see here is your current draw on liquidity. This last week's high. You've got this high back from March 15th, and then you've got a volume imbalance up here before you get to that buy side liquidity. So this volume imbalance here, just like this volume imbalance was a draw, and this weekly volume imbalance was a draw, which you could see, yeah, where was it? Maybe it wasn't. It was a monthly. I can't remember where it was. That's going to be a draw on liquidity. Last week's high, March 15th high, also lines up with this volume imbalance over here. So I am bullish right now on the dollar. We're in a bullish order flow. We're expecting bullish price delivery, and we're expecting the dollar to continue to be bullish. It's going to need to close and displace below this low for us to become bearish on the dollar. So that's what I'm anticipating this week is bullish order flow on the dollar. Drop down to the 4 hour. Excuse me, got the sniffles. Yeah, you can see we're just respecting bullish order flow. You get a couple little pullbacks, but you're seeing highs being taken and lows being respected. This was a big run. Last week on Thursday and Friday, we had this big run down off of the volume imbalance on the daily time frame. Price rejected harshly, violently down. This was a grab on liquidity, and then you saw it immediately return. And now it's reapproaching that volume imbalance level. Maybe it's today, maybe it's tomorrow. Don't know. We're just going to wait and watch on our lower time frame for some liquidity grabs below that would then displace higher. This is a liquidity grab. Quick down, quick back up. So this is just collecting all the orders that were resting under these. We identified this Friday or Thursday or Friday as our draw on liquidity, and just smacked right through it and has popped right back into it. So we are continuing our bullish order flow. Again, you've got last week's high, daily high, weekly high. You have your daily volume imbalance up here, and you've got your monthly drawn liquidity up there. All right. Hey, Ahmad, welcome in. Glad you guys are here. Hope your weekends went well. Just doing some quick analysis here as we get into the Monday trading session. Grab some coffee. All right. On the 1 hour time frame, you can see this was our big run down. We made one more dip down, and then we've flown higher. And now we're reaching back up into this hourly order block right here, retesting this fair value gap, and it's currently holding. I don't expect that to hold. I expect price at some point this week to reach up above last week's high. Doesn't have to. I can be wrong, but I'm pretty sure we're going to get another test of that volume imbalance at the bare minimum. Even if we don't make a new high, we're coming back up into that volume imbalance one more time at least. So we've got some relative equal lows here. Any short-term low or intermediate-term low on these hourly and lower time frames could be targets for runs on liquidity to continue a move higher. So the overall order flow is up on the higher time frames. So we want to trade in line with our higher time frame bias. So because we're bullish on the dollar, we're going to be anticipating prices moving up, but it doesn't just go straight up. It will have some pullbacks. Those pullbacks will hit sell side liquidity that will then continue to push. So that's what we're targeting. You can see on the 30 and 15 minute time frames down here, which are kind of our bellwether time frames to identify our short-term liquidity runs. You have a lot of relative equal lows down here, and you've got relative equal highs above. So for me to be bullish, I would want to see some of this liquidity get run today in this session, or this even. So you've got here and here on the dollar that you would want to see potentially get tagged, and then you would want to see displacement up, leaving a fair value gap nested inside of a breaker. That will be our unicorn trophy buck setup. That's what we'll be looking for. All right, so that's kind of some dollar analysis there, and what we've just run through here will look fairly similar on euro dollar, but in the opposite direction. So let's jump over to euro dollar and take a look. Monthly time frame on the euro dollar. We have been had this big move down. We've since retraced. We've grabbed liquidity, and May just closed. June is now open. We're into our first full week of June, and you can see we have relative equal highs up here with a volume, weekly volume imbalance that you'll see in a minute up there. On the downside, since we're bullish on the dollar, we would be bearish on euro dollar. We've been in a downtrend. We did have a slight break of structure here. We did not displace above this high. We rejected and did not close above it or displace above it. And oftentimes, lack of displacement is as a key indicator of where price wants to go as much as displacement does. So when you don't see a high traded through and closed above with displacement, that's often a reversal sign. And you can see we've now grabbed that liquidity. We have left and engineered more relative equal highs up here, which we'll probably get back to at some point this year. But right now, we've got a big old fair value gap under here. We've got relative equal lows under here. You've got last week's monthly low. It's reached all the way back up and almost completely retested April's low, just like the dollar almost retested April's high. Again, very similar, just moving in the opposite directions of each other. So we would anticipate, is price more likely to take out last month's high or last month's low? We just had a huge bearish month on the euro dollar. Is this month more likely to be a continued bearish candle, or is it more likely to leave this low in place and reach up for the high? Well, for me, it's more likely to reach for this monthly low, last month's low. That's a lot of work. It can certainly just have a big rip up and take out that. But we're more likely, we're more likely to see another down closed candle and reach for at least last month's low and potentially March's low this month. Okay. So that's why I'm anticipating bearish order flow. No wick left behind on this candle like we've identified on the dollar as well. It's just opened and continued to drop. We are reaching back down into, I believe this is a daily volume imbalance right here. Very much like the dollar. It rejected off of that volume imbalance last week. And now we've already tapped back into it here. We've taken out Friday's low. We have the weekly low down here. And then your next drawn liquidity would be this low from March over here. Your monthly drawn liquidity. Okay. That's what we're looking for. That's a daily time frame. So we're bearish order flow. We're respecting bearish order flow. We had a run on liquidity. So you see stops get run here. And then we've had displacement back into it. If we displace through this, this would be a 4-hour breaker, meaning these were the last down closed candles that initiated this run higher into these buy side liquidity. Displacement back away from that. And now we're going to want to see some displacement lower and take out last week's low. It's going to get back into, this is the daily volume imbalance on euro. Remember on the dollar, we have not reached back up into that daily volume imbalance yet, but on euro, we're already at the top of it. So we're going to have some relative equal highs here. We've got some imbalances. You see this big imbalance here and this big imbalance here. This range up in here is probably going to want to get tested. You had a lot of buy side and a lot of sell side, and there was nothing really offered in between. Identify on the lower time frame and hourly, this area right here lines up with this fair value gap over here. Most of the ones in this area have been reclaimed. So you got relative equal highs here on the euro dollar as well. If you look on your bellwether charts on your 30-minute and 15 minutes, the buy side liquidity comes into view up here and up here. This is your Asian range from Sunday's open. We have not left a wick yet, so perhaps New York session gives us a run into that buy side that we see displacement away from. That's what I'm anticipating on euro dollar, and that's what we'll be waiting for to see happen. Pound dollar, it's going to be very similar. They are correlated pairs. We've seen a run above. We did not see displacement above this old high. We're coming back down into this range. So is price more likely to reach for last month's low or for last month's high? Those are questions that help you determine bias. Is price more likely to want to reach for last week's low or last week's high? You got relative equal highs up here on the weekly. Stop hunt, right? So this down close candle initiated this run into these stops, and we've had currently displacement, not strong displacement. You would have wanted to see last week maybe close back. But if you get strong displacement this week, back below this low, this daily close candle, or this weekly down close candle, you would anticipate lower prices and be targeting areas here. You've got some weekly volume imbalances down here. You've got a fair value gap right below that, another weekly volume imbalance down here. So there is a strong sell side draw on liquidity below on the pound dollar. Daily time frame, you've got last week's lows, last 2 weeks lows are down here. You can see it's dropping pretty aggressively back into that. We can take out these. These are old. All right. So draw on liquidity here and here, and then you've got your volume imbalance, as you can see. I don't know if you can see that. It may be, my face may be in the way. This volume imbalance right here on the daily time frame. Another one down here, which lines up with those weekly fair value gaps and volume imbalances that we just pointed out. So I'm bearish. That's all that to say. I'm just pointing all this out to say I'm bearish. I don't need to mark up every line and every notation or box. I see these things, and when I get down into my lower time frames, I'm more concerned about those right now. On the hourly, you can see we've just run a lot harder. We do have some buy side liquidity and a fair value gap that has yet to be tested from overnight, with your Asian range high up in here. So potentially maybe we get a little bit run higher. It could just open with New York and drop. Again, with the debt ceiling deal being reached, it may just want to run. And it's okay if it runs. We're not missing anything. There's going to be setups that form the rest of the week, and we will be ready to take our shot when we get our chance. But I'm bearish. Bearish pound, bearish euro, bearish gold, all of those things. With the dollar being bullish, I'm bearish those other correlated pairs. So we will just watch and wait and see which one gives us the best liquidity run and displacement into our bias. You can see here on the 30-minute, relative equal highs up here, and on the 15-minute as well. Relative equal highs, fair value gap, Asian highs, all up in here. So definitely some targets for price to want to reach up into that we're going to want to see then rip away back into our bias. Let's look at gold. Gold reached back up last week into this daily breaker right here. This is your daily breaker that we have had outlined for a couple weeks now. It's reached up into it a couple times and fallen away. Last week, faked everyone out, ran back up into that, and is now targeting this sell side liquidity, which has been run once, barely, and it's probably going to make a more aggressive run this week into that sell side liquidity. That's on your daily. 4 hour, you can see we ran buy side liquidity. We displaced back through. This is your 4 hour breaker. So these down close candles initiated a run higher. Displacement back through, fair value gap nested inside. So you could potentially see gold rally back up into this fair value gap before it falls off. So here is, let me just, that is a really nice looking breaker. So there's your breaker right there, and then there's your fair value gap on the 4 hour time frame, nested inside. Okay, so that's a beautiful 4 hour breaker. You could trade that. Like you could just target somewhere up inside this, maybe at the top. 50% of that move would be somewhere around the top of that fair value gap. You could definitely use this as an entry on a 4 hour time frame. something like that this week. It's just going to take a while for that to play out. So that's a swing. That's more of a swing trade. You're going to be holding that for a day, or it could take a day or two for that to play out, even to get into entry, and then it could take another day or two for it to hit your TP. But that's a beautiful setup. A run of an old high, grabbing liquidity, displacement back through it, fair value gap nested inside of your breaker. All right. That's nice. All right, on the 1 hour, I'm going to take that off. I don't need that. 1 hour lines up with your 1 hour order block as well there. So again, you can see all of these down closed candles initiated this aggressive run higher, displacement back below. You now have buy side liquidity here on relative equal highs here, and fair value gaps above. So all of that lines up. Nice to see a run up and then displacement below. That could be a really nice play on gold this week. All of this sell side liquidity, you've got trend line, relative equal highs, fair value gaps. We'll watch and see how that plays out for the week. But that's nice. I like it. US 30, look at this. Grab liquidity, right back into our ugly range. Right back into our ugly range. The funny thing about the indices right now is that they're moving with the dollar. The dollar's going up and the indices are going up, which is that's bad trading for the indices. You don't want to see them moving together. Typically, you want to see people moving into the dollar means that they're taking money out of the markets, out of the indices. They're getting out of a risky asset and putting it into a safer, quote unquote, safer asset of the dollar. So the dollar's rising and the indices rose with it last week. So it's still kind of trashy for me. Did have a big breaker structure. You did have a liquidity grab and you did displace above it. This would be a daily breaker here, depending on what happens on today's candle. If you continue to get more displacement and it leaves behind that fair value gap inside this daily breaker, then we could see a run on higher prices up here. But you can see we're still really inside this dealing range. We did grab sell side. Is it just reaching up to grab buy side, refill in this old imbalance up here, which it's already tapped into, just so that it can get back and chop around again all summer long? I mean, that is a very high probability that we're just reaching in to chop up. You know, we've grabbed sell side and now we're going to grab some buy side. Maybe we grab this buy side, but ultimately it's just to get into this crappy and stay inside that crappy range. Massive imbalances from last week left behind that you're going to anticipate price coming in and rebalancing some of this stuff. So the market opened and gapped up right here. The Sunday open. So you would anticipate at least price coming back and getting back inside that opening gap on the US 30. And then after that, maybe it dips into some of this buy side imbalance here before it runs more buy side liquidity. But be careful, it's already reaching up into this daily area here. It's already tapped into that imbalance up here, so I'm not going to touch the indices right now. The foreign exchange currencies are trending and moving much more clean. So why get into turbulent waters when there are smoother waters to sail? All right, that's back on our euro now. So we've kind of identified, these are the pairs that I watch: euro, pound, gold, and US 30. I've identified and laid out what I would like to see happen. I'm bearish, so I'm going to want to see some buy-side liquidity get run at some point during our New York session this morning. and then we'll go from there. I can only stay on. Let's see, it is my time 6:30. I can stay on until just before 8 my time, so maybe another hour and 20 minutes. And then I'm going to have to go and take care of a couple things. So we'll wait and see. We may get a move, we may not, and that's fine if we don't. Let's jump over chat, see who's popped in there. Good morning, 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 Sam. Good day, Jack. Morning, mate. Ghost, morning, guys. French, cool. Welcome in. Ghost, have you been here before? I don't think I remember seeing a ghost in here before. But either way, I'm glad you're here. And I'm guessing you're probably just finished up your lunch hour over there if you are in France. So hope you had some good French cuisine. I don't even know what good French cuisine is. I'm from Texas, man. We just eat barbecue and rattlesnakes. No, we don't. I do eat barbecue. I love barbecue. But I've been on a pretty strict keto diet for the last 10, 12 weeks. I am not like unhealthy just by nature, but towards the beginning of this year, 2023, I just had slacked off a little bit, and I had been my heaviest that I've been. I'm about 6 foot, about 6 foot tall, and I had gotten up to like 185 ish, 185 pounds, and I didn't look fat. I was skinny fat. You know what I'm talking about? Like I wasn't like in my best shape. I had just like over the holidays, I just kind of like completely ate like crap and stopped working out from like the middle of November through Thanksgiving and all the way through Christmas and the New Year and whatever. And so in February, late February and March, I was like, all right, time to fix this. So got onto a keto diet. So I eat a lot of protein, a lot of fat, very few carbs right now, and work out about 5 times a week. I've dropped 17 pounds in the last 10 weeks, and I feel great. Back to my fighting weight, I guess, is how they say it. So, made you feel depleted? Really, man, I feel great on keto. When my body is burning fat instead of sugar, I feel sharp. I feel energetic. I feel clear headed. Um, when I'm burning sugar, that's when I feel depleted. When my body's burning glucose, that's when I feel sluggish and I feel just drained. And I get quick bursts of energy, but I don't have all day energy. And when I'm in ketosis and I'm burning, my body's using fat for fuel, man, I have energy all day long and I feel fantastic. Mentally, physically, I just feel so much better when I'm doing keto. Yeah, we're Rama, we're always waiting. Officially, we're in the New York kill zone for Forex pairs. 7 a.m. to 10 a.m. is kind of the kill zone that I look and watch and wait and hunt for my setups to appear. So we're actually in that time, but a lot of times the 8:30 New York time and the 9:30 New York time are when you get some more movement. We do have a news event that comes out at 10 a.m. New York time today. That could be some volatility. Quite honestly, my data shows me that I don't take a lot of trades on Mondays, and even the ones I do are not as high probability as other days of the week. So I typically come into Monday anticipating not taking a trade. In fact, really, I've said this before. I come into the market every day expecting not to trade. I sit down at my charts, and my first action is my mental action is I'm not going to trade today. I'm not going to find my setup. I'm not going to push a button. I'm not going to put my money at risk in the markets today. That's kind of that's neutral for me, is I'm not trading. I'm only trading if I see an A plus setup happen. And an A plus setup for me is liquidity being run and then displacement through in my bias, my overall bias. So yeah, we're waiting for New York market to move really and to provide us a liquidity grab. We are biased, and so we're expecting price to continue to move lower, but we would like it to see a run on liquidity. So some of these highs up here, we would like to see it get run and then reverse down. Here's your opening weekly gap right here. So this was Friday's close. We gapped up, we dropped, and then Asia kind of ranged, and then London has ranged. So we've carved out liquidity on both sides, and I would prefer for me to find a good trade opportunity. We're going to want to see price come up and take out some highs here and then roll over. Same for pound. We're going to want to see price come up, take out an old short-term high here or up here in the Asian range before rolling over. Same with gold. We would want to see it run up. We identified this 4-hour breaker and fair value gap. So looking for something up in here that price could roll over on that we could get involved with. Let's see. Lost weight October last year. It's below 60 kilograms, so I started working out, eating more. 70 kilograms. Highest weight ever. So you're in a bulk right now. Is that right, Michael? Like you're trying to put on some lean muscle mass? Is that what I'm understanding you to be saying there? I think that's what you're saying, but I don't know. All right, prices. If we look at we want to stay in line with our hourly time frames here. Price is reaching down. We're inside of this hourly order block here. You saw this is our big run on liquidity back in. This is why I want to see some of these levels get taken out. I want to see some of these highs get taken out here on pound. It says, yeah, right now I'm kind of just maintaining, but yeah, I've been trying to gain weight the last half a year or so. I don't know if you guys listened to the Huberman Lab podcast on YouTube. Dude is brilliant and talks about longevity and how to be healthy. And I mean, he's just got so much good. If you're looking to just improve yourself outside of trading, just to be a better, healthier person mentally, emotionally, physically, improve your overall health and just longevity of life. One of the things he talks about is really the best kind of key to living a long, healthy life is exercise and being fit and strong. And it slows aging. It just keeps your body healthy, keeps your mind clear and healthy. It fights off disease better, all those things. But Huberman Lab podcast, if you haven't listened to him, highly recommend you go check him out. I'm giving him a free shameless plug. He is not paying me to say that. He does not even know I am alive and exist on this planet. But great information. If you, and hours, like his very long form, like 2 to 3 hours, he interviews doctors and scientists and, you know, the who's in the health industry, or not even industry, just most of them are like PhDs and whatever, but it's fascinating stuff. Highly recommend. Huberman Lab podcast. Let me see if I can probably, I'll show you who I'm talking about. Yep, this guy right here. I'll throw this up. Huberman Lab. Uh, that's this guy. He's got 3 million subscribers. I'd say he's doing okay on YouTube. But here he just talks about cold exposure, Adderall stimulants for ADHD, science of psychedelics, cold and heat. You can rewire your brain. Alcohol in your health, dopamine, fasting, get bigger, diet, mental health. Again, a ton of great information here on this guy. If you're just trying to get healthier or even mentally just get better and stronger, and how your brain works, how habits form. You want to talk about becoming a self-disciplined person, listen to his stuff. It will change the way you think about why you do what you do and the decisions that you make in life, and how much your diet and exercise can change all of that, how it affects your dopamine, and how, oh man, there's just, again, fantastic. You could spend, and these things are like, look, these things are like 2 hours, 2.5 hours, 2.5 hours, 3 hours, hours and hours of content to listen to. And some of it's very scientific, but he tries to talk in a way that pretty much anyone can follow along. All right. So I'd really like to kind of see the current London lows stay in place right now and see New York kind of not run those yet. I'd rather see New York kind of start pulling back up and take out some of these highs and some of this buy side liquidity up here. That's what I would prefer to see as we go through the rest of our trading session. So, for those that are just tuning in that weren't here at the beginning of the stream, we are on week 2 of our $10K to $2 million funding challenge. We are trading a $10,000 live funded account. And you can see our stats there on our page. We're currently $6.25 in profit. Last week we had 1 winner and 2 losers. I'm averaging just over a 50% win rate. Trading phase 1 and phase 2, we only had 1 loss in all of that. And 13 trading days, we had 1 loss. So we ended up taking 10 trades over those 13 days. And we had 4 winners, 4 break-even trades, and 1 loss to pass phase 1 and phase 2 in about just over 2 weeks' time. 2.5 weeks or so to get through phase 1 and phase 2. And now here we are on our funded challenge. We have a payout coming up on Sunday, June 11th. That's our first payout. So, I'm hoping that we can find at least 1 good A+ setup and take a winner down and get into a payout. And then we'll take whatever that payout amount is plus the refund that we get back, and we will use that to purchase our next challenge. That's the whole goal here, is just to snowball our profits into buying larger challenges, and then using those funds to buy larger challenges, et cetera, until we can get to our $2 million in max funding with Bespoke funding. That's why I picked Bespoke to do this. They're a newer firm. I think they started in September of last year, but they have been great so far. They are not one of the biggest prop firms by any stretch of the imagination, but they have a no time limit to pass your challenges, which is fantastic. I don't know why anybody would be taking time limit challenges anymore. It is not in your favor to trade with a firm that has a time limit. Not in your favor at all. So there are plenty of firms now, good firms out there that have taken off all time limits on their phase 1 and phase 2 challenges. So you can take as much time as you need. If you don't have an A plus setup, you don't just lose 5 days off of your time limit. We could watch the charts all week and not get a trade until Friday. And if you're on a time limit challenge, that was 4 days that you don't get back. And now you have pressure to perform as that deadline approaches to pass a challenge. So don't ever, there is absolutely no reason. Until I max out funding with every no time limit firm, I'm not going to use a time limit firm again. I'm not going to use a time limit firm again until I have maxed out the no time limit. So Bespoke is no time limit. My Funded FX has a no time limit. There's a new one called Funded Engineer that has no time limit. I think Maven Trading has no time limit. And a lot of the time limit firms that are out there are now switching and changing up their models and introducing no time limit challenges as well, because they're going to get left in the dust. They can't compete with all of the newer firms that are taking away the time limit. So they're going to have to adapt or die. So anyway, that's kind of where we're at. We are currently in profit by $6.25. So if I don't take a trade at all this week, I will make 85% of that $6.25 we're currently in profit. Plus, I'll get at least 100% refund, maybe even more, like 125% refund. I can't remember what the discount code was that we had, but either way, if I don't take a trade, I'll at least get my refund and be able to buy one more 10K account and potentially double our funding. But we're hopefully going to be able to find one good setup here, take down at least one to two winner. And for your risk reward ratio and for your edge to play out, you need to take every A plus setup that you can find and identify. You keep your risk the same. You don't ever change your risk amount. Otherwise, your risk reward ratio, the edge that your risk reward ratio gives you, does not work. So here's what I mean. I'm going to move this over here. So let's say you have, you risk. So let's say here's your risk management. Let's just talk about that for a minute while we're waiting on price to do something else. All right. Risk management. So let's say you risk 1% per trade. Okay. And you have a 1 to 2 risk reward ratio, and you know that you have a 50% win rate. Okay. I got into a discussion with a guy on Twitter this last week about some of this. And this is what I think people don't understand about risk reward ratio. When you are when risk reward ratio is key to your edge, key to your trading plan. If you mess with it at all, your edge goes away. So let me explain. Let's say you have a 50% win rate, right? And this guy was saying, look, you should risk more on your A plus setups, and you should risk less on any setup that's not an A plus setup. And all I said was, why the hell are you taking trades on a less than an ideal setup? Like, that's gambling. Why would you do that? He's like, well, this, and he sent me this link to a podcast, video on YouTube of this guy who is one of the quote unquote best stock traders in the world. First of all, I don't trade stocks. Second of all, this guy was saying, he chooses his position size based on how well what he thinks the setup is. So if he thinks this is a really good setup, he's gonna put a big position size on. And if he doesn't feel so good about the setup, he's gonna put a very small position size on. Well, why? That to me sounds like you just have to be in the market, and every day you sit down, this doesn't look really good here, but I'm just going to take this trade. I'm not going to risk very much. It's okay. Like, just trade A plus setups. Okay, besides that, let me get back to the risk management. I'm getting off on a rabbit trail. Only trade A plus setups. Don't trade anything else. Don't take a less than mediocre setup. Okay, that's dumb. Because you need a risk reward ratio to work in your favor. If you take 1% per trade, so let's say 1% is let's just say it's $500, right? So you're trading a 50K account, $500, that's 1% of your account. And you get an A plus setup. So let's just say equals 1%. All right. Here's your trades. So let's say your first trade, you lose, right? Loss. Second trade, loss. Third trade, winner. And you haven't changed anything, right? So this is minus $500. This is minus $500. And then you win, and you are back. You won $1,000, and you're back to break even with a 33% win rate. And that's exactly what we did last week. All right. Except we risked 2%, not 1%. Either way, we're back at break even. You lost 1%, you lost 1%, you won 2% because your risk it stayed the same. Now let's play this out over 10 trades, shall we? So we're going to do a 50% win rate. So we're just going to do a random assortment here. So you're minus 500. We got to get some wins in here because we have a 50% win rate. Win. Oh, not 10,000. And let's say we got another winner. That's a positive another 1,000. And then we'll just go win, loss, win, loss. So let's go loss 1, 2, 3, 4. This is our fourth loss here. Win. Loss. And then you have a win, right? All right, so oops, let me get rid of that. This is what proper risk management looks like, and this is how your edge plays out. 1% risk per trade, 1 to 2 risk reward ratio, a 50% win rate. If you have a $50,000 account, you're risking $500 per trade. At the end of all of this, you're at break even, you're down 1%, you're up 1%, you're up 3%, down 2%, up 4%, down 3%, up 5%. You're going to be up 5% at the end of this. A 50% win rate. And it doesn't matter how you put out the losses and wins in here. It doesn't matter. Okay, a 50% win rate with 1 to 2 risk reward ratio. You're going to be up 5% at the end of this. Okay, now, if you take this same thing and you change up your risk each time, you don't know when you're going to win and when you're going to lose. Okay, so you don't have a set risk. Let's say you start off risking 1% and you risk $500 and you lose. And then you risk another $500 and you lose. And then you've lost 2 in a row. And then you say, well, gosh, man, I'm down 2%. I need to lower my risk because I'm in drawdown and this is not going to go well. So then what do? Instead of risking $500, you cut it in half, and now you're only risking $250. Okay? when you win on 250, your next one's a winner. You're still in drawdown. Versus had you kept it the same and you trusted your risk reward ratio, you would have been back to break even. But instead, you're still in drawdown. Okay? So now you're like, okay, well, I'm still in drawdown. I'm going to keep it at 250. So now you lose again. You do lose a little bit less, right? When you keep it there. But your winners aren't helping you. So now you're down what is it, $750. And you win again. You've only won 500. You're still in drawdown. Right? And then the next one, you're like, well, I'm close, but we're still not in drawdown. So let's go back up here and we're going to risk 250 again. And we win. Let's just keep this same thing going here, right? So we win, we're going to win $500 because we're still in drawdown officially. Now we're back out of drawdown. So let's just tie this up. So we're minus 500, we're minus 1,000. We win, we're back to minus 500. We lose, we're down to minus 750. We win, we're up to 250. We win, we're finally back above break even, and we're at plus 250 for the account. And so we raise our risk back up to our 1%, 500, and we lose. And now we're back minus 250. Minus 250. Okay, right here. We win. We're back up $500. We're back up to 250. And so we're back up to 250, positive 250 right here. We're above break even, so we risk our 1% again, and we lose. And we're back minus 250. Then right here, sorry, yeah, that's right. So we're minus 250 after this loss. We risk 250 again, we win, and we're 250 in the positive. Oops, that's 500. So the total, if I did my math right, total win equals plus $250. 0.5%. Okay? Because you did not keep your same risk reward. 50% win rate. Okay? 50% win rate is good. You only won 0.5%, which you're like, that's $250, that's great. But over here, this one, your total was $2,500. This is why you have to keep your risk reward the same all the way through. You don't know the distribution. If again, these are assuming you have all A+ setups right here. All A+ setups. This one changes. This is a variable. I need to put this up here. Risk changes. Set risk over 10 trades, 50% win rate, you're going to win 5%. Set a not set risk where you're changing it because you get into drawdown or you lower it or your setup. For whatever reason, you're just changing your risk every trade. You can win the exact same amount of win rate and you're going to either come out break even or maybe slightly in profit. But you took, let's say you took all the same trades. These are exact same setups all the way through here. But just because you lost 2 in a row, or you were in drawdown, you're low in your risk, whatever it is, if you change how much you're risking per trade, your RRR is screwed. You can't do that. You have to keep a set risk per trade for your risk reward ratio to work in your favor. I hope you understand that. If you're not a risk reward trader, if you're a structure trader, meaning you're just trading and you're not trying to get 1 to 2, you're just trying to find a fair value gap and you're only trading to the next lowest low, then your position size, you're not using a risk reward ratio. You're not using a set risk reward ratio for your trading style. Then this does not apply to you. You just need to make sure that your winners are bigger than your losers over 10 trades, 20 trades, 50 trades, whatever it is. But I would suggest that you still risk the same amount per trade. Otherwise, it's going to screw you up. It's going to screw up your risk management, and you're going to, it's not going to be helpful for you. You're going to get on a winning streak, and your risk isn't going to will have been the same, and you can't make up the ground or make massive profits because you've changed your risk every time. My advice to people who are not passing challenges is to get a fixed risk that you are comfortable with. For me, to pass challenges and the way that I trade, because I take few trades and I'm only taking my A+ setups, I am comfortable risking 2% per trade. I can pass challenges very quickly. I can get funded. I can start reaching payouts, and I can start building max funded accounts. Okay. That's what I'm comfortable with. I'm not telling you to do that. You have to decide what your risk management is going to be. That's what I'm comfortable with. So here's the difference when you change your risk based on whether you're in drawdown or whether you're in a losing streak versus set risk. Okay. Now multiply this times 100 trades, right? You can see how much money you're either leaving on the table or what kind of a loss you're going to be in based on how low your drawdown is and how long it takes you to get out of drawdown. This is the beauty of 1 to 2 risk reward ratio with a 50% win rate. Don't change your risk and let the magic of probabilities grow your account. Okay. That's enough of that. Should do a whole video on that because there's a lot of confusion out there among people. Yeah, Jack, I'm the same, man. This guy was like, yeah, you should have an A+ setup, you should have a B+ setup, and then you should have a C+ setup. Well, here's how I define that. An A+ setup and then crap. Everything else is crap. And why in the hell would you put your money at risk on anything less than the highest probability that you have? That's gambling. You have A+ setups, and then you have don't trade. It's simple. A+ setup or don't trade. Doing 0.25% risk per trade on my first challenge ever, which I won on Twitter while I'm still getting comfortable with the setup. I'm pretty new to Forex. Man, that's a great plan, Michael. As long as we're with a no time limit firm, 0.25% risk is fantastic. Get comfortable with it, learn the setup, master that. And then when you have the data that tells you how many trades over, let's say 50 trades minimum, all right, I would probably say 100 trades. Once you have the data on about 100 trades, you're going to know what your winning percentage is. And then you can use that as a pretty confidently to know, okay, over my next 100 trades, there's no guarantee that past results are going to guarantee future results, right? We know all that. But you know what your setup is and you know what your probabilities were over the last 100. You can forecast and trust that, okay, I'm going to do something similar. If I stay self-disciplined, I stick with my plan, I'm only taking my A+ setups, then I can increase my risk now to 0.5% until for my next 100 trades. And then I'm going to look at that data and I'm going to identify, okay, my winning percentage went up to 57% over these last 100 trades. Now I'm going to increase my risk to 1% or whatever it is. So I have a 2% daily loss limit. That's my daily loss limit is 2% of my account. And because I have one bullet. I walk into the markets and I'm either going to not trade, which is what I think is going to happen. I think I'm not going to trade today, but I have one bullet in my gun to shoot if a trade comes up. So I'm going to risk my 2% daily loss limit. And I know over the course of my next 100 trades, I'm going to be slightly above a 50% win rate. And I'm going to let my risk reward ratio play out. So that's how I view risk management. You have to keep your risk the same. You have to. Or your if you are a risk reward trader, okay, there are some traders out there that are not risk reward traders, and I'm not saying that one way is better or worse than the other. I'm telling you this is my trading plan, and if you are going to be a risk reward trader, you're going to have a set risk each time and you're going to have a set reward that you're going for on each trade position, then you have to have a consistent risk amount, or else you lose your edge and you lose your ability to be profitable. All right, I ranted enough there. The market's just kind of meandering around, doing a whole lot of nothing. We're into the 8 o'clock hour of the New York session. 8:30 will be our first kind of official market open. And again, I would like to see some of these highs be taken out, and then we get displacement below. I've got about another 45 minutes this morning for our stream, and then I'm going to have to get off. But I will be on Twitter. I'll be watching the charts as I'm out and about, and I'll set alerts, and if I get a setup form before 11:30 New York time, I'll post it on Twitter. Otherwise, if we don't get a setup before 11:30, there will be no trade today. That's my time window, is from 7 a.m. New York time to around 11 or 11:30, and then after that, I'm done. I'm not gonna try and force anything or wait for anything. So yeah, that's the kind of plan for the day. Does everybody understand the risk management or have questions about it, about why you have to keep a set risk amount? I don't know if I explained that too well. I've gotten some requests for people to be like, hey, can you do a video on this and do a video on this? I can. I don't really want to spend a ton of time making other videos. Like, I'm on here every day for a few hours a day already. And the thought of sitting around and figuring out how to put together nice looking videos that people would want to watch on YouTube sounds kind of miserable, actually. Like, I do not have a desire to become a fancy YouTube video creator. This is as fancy as I wanted to be. It's just live stream, show people the process of how to get funded and stack accounts, and then use those small percentage gains on your max stacked accounts to ditch your day job. That's kind of the whole goal here. Anyway, pound not doing much. Gold not doing much. Again, I want to see some runs on liquidity here on some of these relative equal highs. It doesn't have to come all the way back up here, but I do want to see an aggressive run on liquidity. And then I want to see displacement away from that, both on gold, on pound, up into here, maybe this fair value gap or these highs, euro, these highs. I just want to see some run. I want to see buy side getting tapped into. And then we'll be able to find our entry to potentially go lower. Until then, we're just watching and waiting, man. There's not much happening here. This is a typical Monday Forex session. This is what Mondays look like. If I was not doing this live stream, probably the vast majority of time on Mondays, I don't even open my charts if I wasn't doing a live stream. But I've committed to doing a live stream every day, Monday through Friday, starting at 7 a.m. New York time, right? And I'm going to do that until I reach either the end of the year or max funding. And then after the end of the year, I don't know, we'll see. I don't have any commitment to myself to do this beyond the end of this year. So, but if I do that, that's going to be months and months and hundreds of hours of videos for people to have to scan back through and look and see how I took a $10,000 account in funding all the way to $2 million in funding. And that will be what I can leave behind into the YouTube world. And maybe we stick around after that. Maybe we do. Maybe we pick a different firm and do it again. And we'll just try to max out as many firms as we can. Maybe that'll be what I do. I don't know. But I can tell you, I will be here every Monday through Friday, 7 a.m., barring any sickness that I might get or any vacation that I take with the wife or the family. And I just, I will be here as many days as I possibly can. Trade Forex and swing. Do you recommend a regular swap free account? Ghost, I would just do a regular probably. I mean, if you can get a swap free account, aren't swap free accounts? Isn't that a Muslim option? Like, isn't that something about? And I don't know, but I know what I do know about swap free accounts is that they were put in place for Muslim traders to not violate religious beliefs, I believe. Now, again, I could be wrong about that. I've never traded a swap free account and I've never swing traded. So I'm not a swing trader. I'm a day trader. I'm trying to capitalize on a short-term move in the marketplace somewhere on the 15-minute time frame, between the 5 and 15-minute time frame. So typically I'm going to be getting into a trade in one session, and I will be out of the trade by the end of that session, or at least by the end of that day. Typically the end of the session. So I don't swing trade. I don't want to hold positions. There's too much in our current state of affairs that so much could happen around the world that I don't want to be in a position where my stops could be, my stop orders could be ignored because price moves so fast when I'm not around because of some other weird event or news event takes place. I don't want to be in that position. So I don't swing trade. I don't position trade. I don't hold positions open for weeks at a time. I do not have the appetite for that. I'm perfectly content taking my position in smaller time frames, getting in and out. Ooh. Surprised my dogs haven't come down yet, needing to go out. They must have been tired this morning. I do need to check the weather real quick here. What's it going to be in Houston today? %55 chance of rain this afternoon. I mean, it's not horrible. Only 83, so that's good. At least it's not going to be 95 out. getting into the hot part of the year here in Houston. I do not enjoy the hot part of the year in Houston at all. It is oppressive. The heat and humidity is miserable. And it's mostly because of the humidity levels. We're here on the Gulf in Houston, and it's just stupid hot. But 83 is not bad, and if it's cloudy and overcast, I can deal with that. I can deal with that. All right, coming into the 8:30 open here. Again, I would prefer that the market not run these lows here in London yet, but it might. Let's see. Just waiting and watching. I'm not even going to go down to the 5 minute until I see a 15-minute level violated. Okay. And this is straight from ICT 2022 mentorship. You use the 15-minute chart as your bellwether. After you see a run of liquidity in the opposite direction of your bias. So for us, since we're bearish, we would want to see a run of liquidity on a 15-minute time frame of buy side liquidity. We want to see that get tapped. Then we want to see displacement in our direction. Then we look for a fair value gap, and we can look for that on the 5-minute time frame, but we want to see that 15-minute liquidity run, ideally 15-minute or higher. So it could be the 15-minute could line up with a 1 hour or 4 hour, same thing. It's Monday. Even the dogs are lazy, man. They are, I guess. They know it's Monday. I love Mondays. I'm not good just sitting around doing nothing. And weekends when the markets aren't open, and we just moved into a townhome and into a very nice community here that they have everything. Like they come pick up my trash every night. I just set it outside my door. I don't have any maintenance to take care of. They cut the grass. They keep up with the landscaping. They fix anything that's wrong inside. I've got this beautiful new resort style pool to just chill out at. They've got a 24-hour huge gym. They even have a vet tech on site for my dogs. They will come get my dogs. They will walk my dogs for us if we want them to. I walk my dogs. I don't do that, but they've got a huge dog park for the dogs to play in. It's a beautiful, wonderful community. I do love living here, but it means I have a lot of downtime and free time that when we owned our home, I didn't have because I was constantly working in the yard or fixing this or that or keeping up the home, that kind of stuff that you do, the honey-do list stuff. And I don't have much time on my hands. So when the markets close on Friday, I kind of get depressed that Saturday and Sunday are coming. I'm like, God, I would much rather be sitting in a tree stand, hunting trade setups, than sitting here watching stupid stuff on TV. Besides the Astros, I'm a huge Astros fan. Watch them almost every game. But besides that, don't really... Although my wife and I have been watching this show on Apple TV called Silo. Dude, great show. I have loved that show. I think they've got like six episodes or so out right now. They come out on Fridays. New episodes come out every Friday. But Silo on Apple TV is a great show. Highly recommend if you need something, a new show you're looking for. It's kind of a sci-fi dystopian thriller. So it's just about these people that live inside of a silo and they've been there for generations and generations. And so the people that currently live there, so much time has passed that they don't even know why they're in the silo. They don't even know why. They don't know who made the silo. They don't know why they had to live in there. They know that if you go outside, you die. They've got cameras that are outside and video screens inside. And so part of their punishment is like if you do something wrong in the silo, they'll send you outside and everybody gathers around inside and they watch you go out and die because it's so bad outside. But everything is not as it seems, and some people are investigating and digging up and asking questions about who built the silo, why can't we go outside? Is it actually bad outside? Is it really? Maybe it's not. So check it out, Silo. Great show on Apple TV. If you have access to it, highly recommend. Which is your entry time frame? Either the 15-minute or the 5-minute. Anything higher, like 30-minute and 1-hour time frame entries are valid, but I don't like them because you're getting into a swing position trade. For me, you're getting into a swing position trade that very likely I would have to hold over the trading session beyond the day and the new day or the new week or something. And I don't want to do that. So my entries are 15-minute and I'll drop down to the 5-minute. I will not go lower than the 5-minute. My winning probability goes down significantly when I drop below the 5-minute. So 15-minute is probably the best. I love it. But 5-minute, I use probably about half and half, about 15 or 5. But what other shows are you guys watching, man? I'm always looking for. I love sci-fi kind of stuff, but we just finished on HBO Max the show called Succession. That is a crazy show. The season 4 just finished last week or so, and we just finished that. So other than that, we don't really have anything else. And I say all that just to say we do most of our show watching on the weekends. But that's all I did this weekend. Hung out with friends, hung out by the pool, worked out at the gym, walked the dogs, had a couple nice dinners out with some friends. I went to church yesterday. Yeah, man. I'm so glad that the market's open on Sunday nights. I love knowing that when I wake up on Monday morning, I get to come do this. It's the best feeling in the world. I love sitting here watching candles print. I say this almost every time. I know you guys are probably sick of me hearing it, but I love watching this. It's fascinating to me. Learn to love and appreciate the way the market delivers price and the way it prints these candles. Take your hand off the mouse, close your terminal, and just watch price print. It's beautiful. It really is. The symmetry of it, the movement of it, the way it ebbs and flows. It's like it's breathing almost, and it's fascinating to me. I don't think I'll never not be fascinated by it. Some people love to go play golf. They love to chase a little white ball around the fairways and the greens and the sand traps. And they love that game. They call it the beautiful game. Well, soccer's called the beautiful game, I think. But in the States, I've heard the golf referred to that as well. And it's just beautiful. It's beautiful to watch. That's how I feel about watching the charts print. Haven't said this yet, but if you guys could hit that like button, hit that thumbs up button. We don't have a ton of viewers here yet. We're growing. First couple weeks the first week I had 0. The second week I had a few traders, Corey and Muhammad. I don't know if I haven't seen Corey today. I don't know if he's here, but Corey and Muhammad, man, they're my OGs. They've been watching since like halfway through phase 1. So I was streaming to nobody, and then I was streaming to a couple people, and now I'm streaming to, I don't know, maybe 10 people at a time here are usually logged in on average. After we passed phase 1 and phase 2, more people found out about the channel on Twitter and YouTube Shorts and stuff. And so subscribers are starting to grow. People are starting to tune in. After we get a payout, I imagine, and buy another challenge, We'll probably get another bump, but the more if you like it, it does help increase exposure. And I'm not selling anything, just sitting here talking it all through. Here we go into the 8:30 hour here. Markets opening. Not a ton of action anywhere. Nothing super exciting. Dollar is pushing higher here as we open at the 8:30. It's pushing above those highs. Pound is dropping and Euro's dropping. Euro's taking out the London session high. I was kind of hoping that would stay in place and we would run some liquidity here, but we haven't had any 15-minute buy side liquidity get run yet. And so until that happens, we do nothing. We're just sitting in our tree stand, enjoying and watching and waiting. You did have a little bit of a run here in gold, if you'll see this. You had a little bit of a run right here. You had some buy side liquidity right here on gold. So we were making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower low, a failed higher, making a new high, and a failed low, and then we run that liquidity right here. So you had displacement up, and then you have displacement back down. So these down candles initiated that run on buy stops, which then got displaced through. You had a fair value gap left behind, nested inside that breaker. That was a valid entry. It hadn't run the sell side yet, so I'm not saying this is a trade, and we didn't see this. I wasn't really looking at this. I wanted to see price come up into here and not here. This is a very short-term buy-side liquidity run, but it is valid. It did grab liquidity. It ran stops and then displaced lower. And I probably would have targeted about 50% of the bodies. These two bodies together would be about right there. And your stop would have been above the candle that created the fair value gap here. Here's your fair value gap between this candle and this candle. So this candle created the fair value gap. You would put your stop either at the top of that or at the body. I would probably do the top wick there and target 1 to 2.15-ish, somewhere around there. So you would have gotten triggered in. You would have set your order as this candle closed bearish and left behind a fair value gap. That's where you would have set your order. You could have targeted the entry, but that's going to give you a bigger 1 to 2. I like to dig a deeper dig into the fair value gap and into the breaker block, typically around 50% of the breaker or the fair value gap, whichever one is a little bit higher. So in this instance, I would have targeted 50% of that breaker block, put my entry here, stop above the candle that created the fair value gap. And you can see how price reacts off of these setups. That's a nice setup right there. But for me, I said this when I got on the stream, I would have wanted to see a deeper run of this buy side liquidity because we still had this 4-hour breaker block up here with this 4-hour fair value gap. I would have liked to have seen price run up a little bit higher. This is a lower time frame entry right here. Run of the liquidity, right? You have buy stops above these relative equal highs. It ran that, and then it displaced away from, after it grabbed liquidity, it displaced below the candles that initiated that run, leaving behind a fair value gap inside of the breaker. These two candles together are your breaker. So if you take those two candles, if you look at it on a 30-minute time frame, that's one candle, right? But the fair value gap doesn't exist on the 30-minute. It exists on the 15. If price gets down below that level, this old low, and you were in this trade, this would be your break-even level. is as price, basically where it's at right now, maybe a little bit lower, I would move to break even, and that would be a risk-free trade. And then if it came back up and hit break even, the trade's done. It's either, from this point, it's either going to run sell side and tap, get you a hit your take profit, or you're going to be break even. 1.5R is where we move to break even, at least on my setups, the way I trade. 1.5R. I'll leave that there just to play out. That is a nice setup. I'll go ahead and mark it up for you. Here's your breaker right here. That's your 15-minute breaker block. And you have your fair value gap that is nested inside. Right? That's what our A+ setup looks like. Run of buy-side liquidity, displacement through the breaker, fair value gap inside of that breaker. And typically, that setup forms a couple times a week. And on each pair. So if you're watching 3 or 4 pairs, you could probably find 4 to 5 setups a week, but one of them is probably going to be stronger or better than the other, which is why you only take one. So we watch all of them. These are all correlated pairs. They move similarly to each other. One of them sometimes will grab liquidity and the others won't. Sometimes 2 will grab liquidity and the third one won't, something like that. So we just watch all 3. You're more than welcome just to watch one pair to trade. If you're a new trader, only watching one pair isn't a bad thing. It's not going to hurt you. Watching multiple pairs can get confusing. Pounds dropping lower, euros dropping lower, dollars running higher. Again, this is the volume imbalance that it rejected off of last week. These are daily wicks up here. All of these are daily wicks. This is like a Tuesday wick, or Wednesday wick, Thursday wick, Friday wick, that kind of stuff. Or Tuesday, Wednesday, Thursday. I can't remember exactly. What is that? That's Wednesday, Thursday. So it's reaching back up there. So we'll see what happens when it does that. I was kind of hoping it would come down and grab some liquidity before it did that, but it does not appear that it's going to do so. US 30 looks like it's trying to fill in the weekly opening gap there. As the market's been open now for about 7 minutes. I'm going to stay on for about 10 more minutes, guys, and then I'm going to get off and head about my day. We have a liquidity pool on dollar, 15-minute chart, 104.2 at the inverted fair value gap on the daily. Let's take a look. See what Steven's talking about here. You got a liquidity pool, 15-minute chart at 104.2. Yes, you are correct. That's what, Steven, that's what I was hoping as we opened the market. And it still may do it. It still may do it. But that is the first liquidity pool that I identified as well, that I would want to see price reach down into that fair value gap. Bare minimum, but you also have a liquidity pool a little bit lower here. So I was hoping price would reach down into there as we open the markets and then displace away. And it still may do it. We still have about 2.5, 3 hours left. So at 9:30 when the New York Stock Exchange opens, you may see a dip. Maybe it reaches up in here into this volume imbalance again, rejects away, grabs liquidity, only to displace higher. We'll just have to wait and see. But that's kind of where we're at so far. I wish I would have, kind of wish I would have seen that monitoring gold there. I wasn't really paying attention. that was, so we got on to the stream when price was right here. When the stream opened, price was right here. And I had said I wanted to see price run up above these equal highs, but it had already run equal highs right here, and I did not see that. And then we get displacement down in those first 15 minutes that we were on the stream. Underneath here, your next candle closed bearish, and that would have left your breaker with your fair value gap right there. And you would have gotten tagged in. And now here we are. You would definitely be at break even had we taken that trade right now. But we didn't take that trade. I'm just leaving it on there just to show you what a good clean setup looks like. You get a run on buy side liquidity and then displacement below, fair value gap nested inside. We were already bearish bias, so that was in line with our bias. We knew we had to draw on liquidity down here. So pretty trade. That was a pretty trade. Pound is running away, euro's running away. That means dollar's running up higher. You trade only pairs against the dollar. Why don't you choose a pair that's not against the dollar? Like dollar cat. Well, those are all against the dollar. They're just in the opposite direction. So the dollar is listed first, but they're still against the dollar. Ultimately, Steven, it's just because I don't want to watch all the different pairs. Like, I don't want to trade. I don't need to try to find a setup every day. I find enough setups during the week on these pairs. I'm very comfortable with these pairs. I've been watching these pairs for a very long time. I'm very used to how they move. I'm very used to how they respond to PD arrays and to news. I know their pip ranges. I know what their daily expansions look like and feel like. Those other pairs, I'm just not familiar with them. And I don't want to just have 10 tabs open up here where I'm flipping around all the time in between. You can get confused easily. It's just, yeah, you don't want to be watching a lot of pairs. You want to, for me, this 4 pairs is my max. And I've already ruled out US 30, so it's 3 pairs. It's euro, pound, and gold. That's what I am most focused on. But all those other pairs, they're all against the dollar. They're just the inverse of, instead of going down, they'll be going up right now. I have USD JPY up here because somebody last week had asked me to, they just asked me what I thought about it. But I don't, GJ and UJ, I don't trade these, but they were open from last week. These are the 4 pairs that I monitor right here. Euro, pound, dollar, gold, US 30. And I've ruled out US 30 because it's been moving in conjunction with the dollar, and that is not a healthy environment to trade the markets in. When the markets are moving with the dollar, something's not right. And euro and pound have been trending very nicely. And so that's why I've been focused on them. All right, y'all. I think I'm going to call it right here. Price did not decide to do what I wanted it to do and anticipated it to do for me to have my setup. So I'm going to go ahead and call the stream right here, right now. Follow me on Twitter at Venator Trading over on Twitter. If something comes up today, I will post it over there. But if there's no setups by 11 a.m. New York time, there won't be a trade today, and we'll be back at it again tomorrow. I'll be here every day this week, Monday through Friday, 7 a.m. Like this, please. If you haven't yet, please hit that subscribe button. And I hope you guys enjoy the rest of your day. And we'll be back again tomorrow. All right. Check you later.